Palantir stock. Palantir is the top subject of today's video. We're going to speak about this right at the beginning. Palantir stock got hit about 6% plus. I got hit about $8,332 here today on Palantir stock in the public account. So they got downgraded to a sell rating. We're going to speak about this, go in depth on that one, okay? Then I want to go ahead and react to this video here. Earnings aren't there. They're slowing down. I thought that would be an interesting one to react to. Then one of the biggest bears on Wall Street, Mr. Private Wealth himself. We're going to hear what he has to say about the market, where he sees things heading here. Looking forward to getting that one. And then last but not least, Dan Ives. Speaking about Tesla stock, Tesla's going through code red situation right now. Looking forward to getting in that one. I appreciate y'all joining me as always. All I ask in return, smash a like or slightly tap the like button. It's up to you. I need you to do one of those two for me here today. That's it, okay? I appreciate y'all. If you enjoy my videos, make sure you subscribe to the channel. That's it, okay? Alrighty, guys. So first off here, Palantir dips after these folks. Now, a lot of people don't like to look at if somebody writes a negative article or let's say an analyst downgrades a stock, whatever. Me personally, like I've been doing this for so long, I actually welcome it. I love it. Like tell me why my stock's crap. Tell me why my stock's going to crash. Like tell me. I love it because I just love to see, am I missing something here? And then I can kind of, say, no, that's baloney, or maybe they got a good point, okay? So let's see what happened here. Palantir stock fell 2% pre-market, but obviously it fell over 6% today. So this had a very negative, weighting on Palantir stock. After these folks, Monez, downgraded the shares to sell from neutral, citing the company's rich valuation. So they went from a neutral to a sell. Rich valuation. So it's a valuation call. The firm has set a $20 price target on the stock. So they're not that crazy bearish. I mean, the stock is, 23 today or so. So not crazy bearish. The analyst said that on the back of the unprecedented generative AI hype cycle, Palantir surged in 2023, and the stock's upward trajectory has continued in 2024, leaving the company with what they view as a very rich valuation. In their view, Palantir, which offers software platforms for the intelligence community, is well positioned to benefit from the long-term AI trend and can capitalize on volatile geopolitics. However, the analyst thinks that revenue from the government-related contracts has proven lumpy, execution spotty, and valuation excessive. And he believes the darkest days of the economic downturn are ahead. So they're also bearish on the economy, right? So what's my opinion on that before we react to these three videos here, okay? So he's got a point in regards to valuation if you're looking at a very short-term perspective, right? Sure, Palantir, look at the forward P of Palantir. It's very high compared to the stock market. Look at the trailing 12-month P. Sure, it's insanely high compared to the stock market, right? But Palantir just reached their infant stage of profitability. And usually what you see over the next 2 to 3 years, when you just finally turn your bottom line from basically losses to profits, is you actually see an exponential rise in terms of your earnings power, which is likely what we're going to see play out for Palantir over this next, we can call it, the next 2 to 3 years. We should see their bottom line increase dramatically. And so that will likely eat up that forward P, and it will likely end up making the company look like it might have been cheap actually right now, or at $20 a share versus looking very, very expensive, right? Now, in terms of their view on 2023, stock went crazy. It was phenomenal for all of us Palantir shareholders. 2023 was beautiful, right? And 2024 hasn't been the worst either. But remember, in 2022, Palantir stock got absolutely obliterated and devastated. And so this stock was at all-time lows in 2022, right? The stock had crashed 80%-ish from the peak that it was back in 2021, right? And that happened very, very quickly. So when you have a crash like that, there's some get back there. We're not even remotely close to where the stock used to be just a few years ago, right? Not even close. Like Palantir used to be a $40 stock, and we're talking about $20 a share, right? So we're still so far away from just getting back to where we used to be. We basically need like a double up from here. And so, that is always kind of a moot point in regards to the stock's gone up a lot. So therefore, it doesn't mean anything. At the end of the day, all that matters is valuation, where the company's going in the future. So the bottom line is if Palantir comes through this year, reports a pretty epic acceleration of revenue growth and a bottom line that keeps beating estimates throughout the year, the stock will continue to climb. Now, if they come in and miss, then we're talking, and then the bearish note will make sense. Okay, all right, looking really forward to getting in these three here.
Well, how do we get here to these record levels for stocks in the first quarter?
And, if you had to tell me what is my, and I'd love to hear from you guys, what is your 12-month price target for Palantir stock? That gentleman has it at $20, right? I'd love to hear your guys, price target for Palantir stock. My opinion is 1 year out, if Palantir comes in and does what I think they can potentially do and knock revenue growth out of the water and that bottom line starts to go up dramatically, I think the stock price could probably be somewhere between $27 low end and maybe like $33, $34 high end a year from now, if they come in and knock it out of the ballpark, right? Once again, if they don't do that, then sure, we could go right back down to 15, 18, under 20, something like that, right? But if they come in and they keep reporting this AIP growth and this 70% rise in commercial customers, US, it's going to be off to the races, because at the end of the day, you can't let companies like Palantir run away from you, because once they run away, they're gone forever. They're gone forever. These type of SaaS type companies, which Palantir kind of gets put into that group, right? Software related companies, once those babies run, they're gone. They're not cyclical. They're not like an auto company. They're not like a home builder or even a chip company for that matter. Those ones, they might come back to you in the future because they go through these kind of ups and down cycles of their business model. More SaaS related companies, which once again, Palantir gets put into that category, when they run away from you, they're gone forever.
And what do you think it says about where we might go next?
Well, John, it's always hard when we hit new highs, a quarter like we just had, record quarterly growth in the S&P, to come on and be that guy, the cautious guy. I'd like to say the voice of reason. But in this momentum-driven market, right, it's basically a FOMO market at this point. Momentum as a stock driver, always worrisome, very fickle stock market driver, unlike valuations or growth or profitability. When people are investors are buying stocks simply because the stocks are going up, it's circular reasoning. It's like picking up nickels in front of the proverbial steamroller. So we definitely be a little cautious here. I'd love to come back on in 3 months. Let's talk after another quarter, because I do not see us repeating this quarter as good as it's been.
Okay. Well, I guess it's not saying too much to say we won't repeat this quarter, but could it still be good from here? I don't know. Well, I want to move on to what you're saying about fixed income. You favor the safe yields there before we even get to the appreciation that would arguably come if and when we get the rate cuts that many expect. Tell me more about that and how much you lean into fixed income right now.
Only at the margin. We're not market timers. We don't move in and out of the market wholesale. So we're tilting about 5% into fixed income assets, along with some other tactical positioning within the stock market, small cap and REITs. But in fixed income, generally staying higher credit quality, a little bit long on duration. To your point, looking for the slowdown, that's probably the safe place to be. And with yields, with a 4% handle or better, depending on how low you go in the credit quality, if you do the math there, maybe a 2% drop in rates if it were across the board. We're not envisioning that so quickly. Average duration around 5-6 years. You can get quite a hefty appreciation, something much more attractive than what we see in some of the large cap growth stocks right now.
It's interesting to hear you talk about this, because what was so unusual about this first quarter is the fact that you had this torrid rally in stocks, but you also had gold reaching a record high. You had crypto and Bitcoin touching a record high. You had a big rally in crude and the energy commodity complex as well. The dollar re-strengthened, particularly notably against the yen here in recent days and recent weeks, and yet Treasury yields are higher on the quarter too. Is that a sustainable?
Yeah, but to be fair, to push back against all that she just said there, very important everybody understands, it's not just happening for no reason. It's happening because there's a view that the economy is getting better. There's a view of that, might argue against that, but there's a view that the economy is getting better, and there's actually factual that earnings are getting better. And so if you look in this, and that's for a lot of the biggest companies in the world, the Metas, the Nvidias, the stocks that matter the most in the market, their earnings are actually improving. Their revenues have improved dramatically versus a year ago. And so when you have earnings all improving, revenues, EPS, right, with a view of the economy getting better, that leads people to say, buy stocks, right? Now, that could be short-lived. If we get another batch of inflation, that's going to cause a whole bunch of problems, right? And then, if recession eventually comes 6 months, 12 months, 18 months, that's going to cause a lot of havoc. But for now, which, the market's usually looking out over the next 6 months, the market's felt very comfortable on at least where things will be 6 months from now. But 6 months from now, things could change a lot, and maybe the market's pricing in different scenarios. So that's just a little food for thought in regards to that.
Dynamic going forward, and how does it speak to dig even more deeply into your investment thesis around fixed income?
Right. We do not believe it's sustainable, not in the near term. Now, maybe by the end of the year, once we get through some of this market froth, right, or animal spirits, I think is a term I've been seeing lately. It's all part of this momentum trade that's been going on. Earnings, they're just not there. They're slowing down. Aside from tech and a few key names.
Yeah, that's where you got to differentiate here, sir. Where are you talking? If you're talking about construction related, well, we know the government's spending like it's nobody's business on that, right? The home builders, if you don't want to talk about the home builders, they've looked phenomenal in terms of them, right? Obviously, big tech, for the most part, the majority of them look like their businesses are in a lot better place than they were a year ago, right? Not every single one, maybe not Apple, maybe not Tesla, but outside of that, it looks like almost all the rest of them are. And so,
The sectors of the S&P had negative or low single-digit earnings recently. So we don't see the fundamentals driving it. And with rates staying high, at least for the foreseeable future, you'd have to be a professional contortionist to find something positive in those latest CPI reports. So with rates staying higher, we're not going to see PE expansion here.
That's fair.
It feeds into our outlook.
That's very fair. You're probably not going to see much, if any, PE expansion from here. That's very fair.
Which is relatively cautious, again, for the next quarter or two.
The market's got to be driven by earnings beats at this point in time to push the whole market up. If you don't get earnings beats, it's going to be very difficult to get the entire market up.
Okay, but if rates are staying higher because the economy is stronger and consumers are remaining at least a little bit more resilient than everybody had anticipated, isn't that actually a good thing potentially for earnings?
Potentially, but rates are staying higher because inflation's staying higher, and the Fed's afraid to pivot too early, per the governor's comments the other day. So it's not necessarily the economy is so strong. We see it as slowing down or decelerating with high inflation. That's not a great outlook for stocks.
Okay. Rich Weiss, great to get your thoughts today.
And so if his view is correct there, right, where he talks about a slowing economy, a worsening economy, and high inflation, what does that equal? You're on the spot. What does that equal? You got to know the name of this. Stagflation. If his kind of view there is right, then you kind of get into stagflation, which could then lead to job loss and those sorts of things. So it's a very bearish view, and that's always possible down the road. We haven't seen stagflation yet, but things could change. It could change 6 months, 12 months, 18 months from now. Chris Toomey, he's been very, very bearish. He runs private wealth, and let's hear what he has to say.
Here at Post 9. Well, you're consistent. I'll give you that. But why are you still negative? I'm trying to think. You know what? When I knew you were coming up, I'm like, how am I going to handle this interview? I feel like I ask you the same questions every time.
Yeah.
Because I have no choice.
Right.
But I mean, at some point, as this market, as we just said, is off to its best start in 5 years, you would think that your position would change.
Right.
Why hasn't it?
I think it hasn't because while we have seen tremendous economic growth that we weren't expecting, we've seen inflation come down, we've seen a very strong labor market, the things that we're concerned about continue to be things that we're concerned about. And I think why we're particularly concerned right now and why we think this rally is so remarkable is I think if you look at the pace over this period from October to now, we actually have not even seen a 2% correction. And over that time period, we haven't seen something like that in over 6 years. If you look at all of these sectors that are doing well, on a technical basis, they're all either overbought or extremely overbought. So in our mind, I think even on the short term, we would all agree that the market could probably take a breather. So I think from a technical standpoint, from where we have been, I think it wouldn't surprise us to see a pause, or more importantly, probably see a pullback, given how far we've moved and how aggressive we've moved.
Okay, that's all fair. And I think you're right in suggesting that nobody would be surprised if there was a pullback, some kind of a correction. I mean, that's what happens in bull markets. However, you were negative. You've been negative since before the market got into the conditions you suggest now make it ripe for a pullback.
So, and let's talk about the underlying thesis behind that, right? So the underlying thesis was the Fed was not going to be as aggressive in cutting rates as the market was pricing. And we saw 2023, instead of rate cuts, we saw rate hikes.
All right, so let's read through his note bullet points here that he's sending to the private wealth clients here, okay? Saying market is extended on a risk return basis. I can't disagree with that. Negative 10% pullback would make P more reasonable. Definitely, just factually, that's true, yes. Economic trends aren't a recipe for success. I think you can make arguments both ways. I really think you could make arguments both ways.
We started the year, you talked about this before, instead of giving...
But very important, I do agree with this. This point right here specifically, right? And that's just literally factual. Market is extended on a risk return basis. Yeah, if I look at the market in general, I would definitely say the market in general is not super attractive right now. If I'm just thinking S&P 500 returns over this next bit of time, it's not. But, 10 years from now, it will look like a deal. But, a year from now, it might not. So I can't say I disagree with that.
Rate cuts.
But with that being said, there's a lot of steal deals in the market. There will be a lot of stocks that will perform great over this next year or two, even if the market doesn't perform great.
Potentially getting two, right? And then let's talk about earnings. Earnings last year were flat. Earnings this year, even with the dovish tone and economic growth that we're talking about, are not really going all that much higher. So if you look at the performance, 90% of this performance is PE multiple expansion. And so at that point, are you looking at a situation where the equity market, from an equity risk premium standpoint, is really not giving you that bang for the buck? In our mind, yes, maybe you're right. This is a bull market, but as Roy Newman said,
it's a bull market, my friend. I mean, the market is telling the story, not me. Right.
Of course. But what is driving that market, right? So even if you go deeper into earnings last year, right, you take out the market cap weighted, you look at equally weighted. Those earnings are negative. If you strip out the Mag 7, earnings are actually down 10%. And you're talking about breadth in the market for this quarter, which you're starting to see particularly in February. Mm-hmm. But if you look at the performance, the 10% performance, 30% of that is one name. Right? So you are starting to get some breadth, particularly with some of the larger names in different parts of the sectors. But the median returns are still around 2 to 3% in each of those sectors.
Okay, let me take a couple points off of what you said, and we'll debate this. Earnings. So we went from an earnings recession, right? We were negative earnings for multiple quarters, and then, as you said, we got flat. But now we're going to grow again. Right. So the trajectory from earnings looks like this, right? We went from negative to flat to now we're expected, as I said, for the first quarter, some 5%. Now, maybe down from what was 10%, but it's nonetheless 5% versus negative.
Right.
So that's one thing. And then do you really want to be negative on the market into a global cutting cycle? Well, which is what we're going to have. We're going to have that
at some point, right? But let's talk about what are the things that might affect that, right? So growth has done well, right? We saw January, February CPI and PPI numbers that ran hotter, and you can talk about owner equivalent rent and so forth. But I think some of the other things that are a concern are the fact that if you look at gasoline prices, right, which was a tailwind last year. It's up 16% this year. Food prices are up 9%. Consumer sentiment's going down. Concerns with regards to the quit rate is going down, right?
Wasn't consumer sentiment good today?
Yes. But, look, there's a variety of different consumer sentiment numbers.
But come on, the consumer's been good.
The consumer's good.
The consumer's been strong, and optimism still remains.
It does, but what's going on underneath the scenes, right? You're in a situation where the consumer has got over $1 trillion worth of debt that's paying 20%. Right now, non-mortgage debt is actually equivalent to mortgage debt. So you're basically paying exactly what you were paying before, and savings have come down. So the issue is, for me, is not just the fact that the rates have to come down. If rates stay higher for longer, that's going to be a really problem for a variety of different areas of the economy, and it's not being priced in right now.
Oh, boom, 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 boom. 100%, okay? Before we get into Tesla here, let's just speak about the state of the consumer, right? The average person. So, real wages have started to tick up over the past year. That's good, right? With that being said, we're not really seeing great results with a lot of the consumer-related companies. You look at Nike's results, obviously look at Lululemon. That's one of the worst performing stocks here in the first quarter of the year, right? They showed it, I think, either in this video or one of the previous videos. I think it was down like close to 25%. Apple, obviously the biggest consumer company pretty much seen out there, right? Their numbers have been not impressive at all. So when you look at a lot of these consumer-related companies, look at RH, and obviously they cater to the rich and the wealthy, right? RH's numbers were awful. It was a D- income statement. I graded that income statement inside the private group last night. It was a D-. It was horrible. So their stock was up huge today because of who knows what. But, it certainly wasn't anything on the conference call. It's just the hope of things getting better in the back half of the year and the guidance, which we'll see if that happens. But, I thought he brought up a lot of fair points there. Okay, overall in regards to the overall market, right? Next one up here, Dan Ives. Tesla's going through a code red situation.
Partner, I don't know, it just makes me smile a little bit, Dan. You could be lowering your numbers because the stock's at 175 and your target's 315. That'd be a good reason. We'll get all your other reasons, but that's a good start, I think. But it's a little bit odd. You're going down $15 to 300, and you're keeping an outperform rating. All this sounds sort of, I don't know, too little, too late.
Yeah, look, it's obviously a great point. Look, we're bullish for Tesla on the other side.
Well, you must be, because you still have a $300 price target. What's that return from 180 to 300 is? So you're still looking for like a 70% return.
Yeah,
right?
and look, we've been here before. In other words, there's no doubt, and we call it out. This is a code red situation for Tesla. They are going through some dark days in China from a demand perspective. But Joe, I believe on the other side of this is a company, not just from an FSD perspective, but from volume that could start to get 2.5-3 million vehicles per year as we go into the next few years. Our whole point here is you're in between two growth waves here. They clearly need to lay out a strategy for investors because this is going to be a rip the Band-Aid off delivery quarter next week. And there's no smoke and mirror about it. And, I think right now from Musk, I kind of view it as a fork in the road period to handhold investors through this.
You
hold your horses for just a flip and flapjacking moment, okay? I take a little bit of exception to Tesla needs to lay out the growth path forward for the company. They've done that. If you are not caught up on what the growth trajectory is and how Tesla grows over the next 3-5 years, you haven't been paying attention because they've laid that out now at this point in time, okay? Here's what we have going on. We got the refreshed Model Y and Model 3 now in the marketplace, right? On top of that, Tesla's entering new markets. We know that, right? On top of that, Cybertruck, right? Cybertruck, obviously low volume in the short term, is going to be much higher volume over the longer term, right? Huge benefit, and that truck could end up being extremely profitable for Tesla. We do know pickup trucks are usually among the most profitable. Ask Ford how they make their money, okay? That F-Series pickup line is ridiculous in terms of the profitability there, right? We've got FSD getting pretty darn far along at this point in time. People might debate whether it's done the next year, 2 years, 3 years. I can tell you it's sooner rather than later in regards to that, seeing the improvements they're making there. And assuming the AI continues to, be able to fix any last issues it has in the last 1 to 2% of conquering of driving here. Okay. Then on top of that, you got the services opportunity, which is just really starting to emerge, and that number is getting bigger and bigger for Tesla, and it's going to start reaching some really large numbers here over this next few years. On top of that, you have Model 2, or whatever you want to call it, the affordable car coming in the market in the next couple of years here, right? Which is going to knock the doors off to the entry level, and that's just going to be brutal for anybody that wants to compete in that under 30K bracket. It's going to be absolutely brutal to try to compete with Tesla and in regards to that whole situation. So you've got the growth path there. I just laid it out for you. It's a bunch of different things all going for the company over the next many years. And so, it's just up for them to execute. And obviously, everybody and their grandma that sells EVs is all getting on the Tesla supercharger network, which goes back to the supercharger abilities, right? Oh, we got Semi. I forgot to mention Semi.
First quarter delivery.
Oh, the energy side of the business, which has actually shown very impressive numbers very recently. I forgot about that. Like we got the, like I said, if you haven't been paying attention, you wouldn't know the growth story around Tesla over the coming years, but it's all been laid out.
For Tesla, and we'll find out next week, but you expect it to be a nightmare quarter because of China and China demand.
Yeah, I mean, China, we originally had that up 3-4%. It's going to be down 3 to 4%. And the issue here, is just that Game of Thrones price war that's happened in China with EVs. It's hurt Tesla, and I think right now the problem is, do they continue to cut prices, or do they ultimately hold serve and focus on where demand could be? And I think as much as we talk about FSD and why we're long-term bullish, and I do believe we're sitting here a year and a half from now at $1 trillion plus market cap.
Yeah, so when we were up at 300 or 299, wherever it was, I get at that point, were you still worried about supply and you didn't see the demand issues coming?
Yeah, I think where we were dead wrong is underestimating just how bad China demand was going to be.
China demand.
So for us, when I look back, that's really what's caught us, I think, many by surprise in terms of just how quickly demands come off, but also with no adult in the room and with 2 disaster conference calls in a row, they haven't laid out guidance. They haven't given the strategy. You've had other noise.
No, baloney. Okay, listen. That last conference call was not a disaster. I can understand, fair point, on the previous conference call. That last conference call was not a disaster. It was not. I walked away and I thought that was a good conference call. In terms of guidance, okay, Mr. Dan Ives, you're Mr. Apple. How's Apple's yearly guidance been looking? Oh, they haven't been giving it, huh? Ever since Rona happened, they magically started taking away the guidance, right? So you can't say, oh, Tesla's not giving guidance. Apple does the same exact thing, right? So that's a bunch of baloney in regards to that. Like, Apple used to give their yearly guidance, not anymore.
In terms of the AI issues with Musk and obviously
Apple even used to, many times back in the day, they would give like guidance around how many iPhones they were planning on selling. That got taken away.
Where comp issue, which is added to it. But I think that's the problem. They haven't laid out the strategy to where investors right now feel like they're blindfolded playing darts.
Do you have a price target?
No, if investors didn't really understand the game plan for Tesla, this stock would be trading at $79 today, not $179. The reason the valuations actually held up pretty darn well, considering everything that's going on in the business model, is because people understand the bull case I just laid out a few minutes ago and how Tesla gets to growth over the next several years and grows the company quite exponentially.
300, but do you think we're near a low here? Depending on what happens next week?
I mean, I think right now, a lot of the bad news is big. I mean, we wouldn't be bullish if I didn't think that this stock is
Why not put a buy on it then?
That is our highest rating.
Outperforms your highest rating?
Outperforming. It's on our top picks list. And I just view it as we've been through these white knuckle periods before over the years. This is another one now that we're hitting. And we're just calling it out, give out the strategy to what Musk needs to do in the conference call to get through some dark days.
He doesn't really listen, though, to we've seen when you ask him about how do you feel about criticism, he doesn't, he's going to do what he thinks is right.
Got nice Nikes on.
He's in a position to be able to do that.
No doubt, but I do
Will he, you said no adults in the room, but you think he'll return to to giving the street what it wants in these calls?
Well, I think ever since they lost their CFO since August, there have been basically Nightmare on Elm Street conference calls. This, I believe, is a wake-up call from a demand perspective. And look, if they don't lay this out in terms of the strategy and turn this around, then you could not just have some darker days, but I believe a lot of investors will start to lose faith in where the Tesla story is going, even though we're in between two growth waves. And that's our whole point, is that this is a nightmare in the near term. There's massive growth on the other side. You need to handhold investors through it, no different than we've seen Jensen, Cook, and the others over the years.
Yeah, that's what Musk has done. And Tesla stock's doing pretty darn good. I'm telling you, if people didn't understand the growth trajectory Tesla has over the coming years, this company would be trading less than $100 right now. Look at Tesla's forward P. It's very high. Okay? The market cap's over $500 billion right now. The fact is, the fact that, you want to try to make a case that stock's supposed to be 300 or something right now is just ridiculous. I mean, we're trading at, in my opinion, once again, a pretty darn good valuation. Now, in terms of predicting, is Tesla stock bottoming here or not? My opinion is, sure, as long as the market is fine. But we got to be honest about this. If we got a 5 to 10% pullback in the S&P 500 for whatever reason, let's say inflation fears, I don't know, whatever, okay, whatever they want to throw out there, Tesla stock's going lower, okay? If we get a 5 to 10% pullback in the S&P, it would hurt Tesla quite a bit. And so that's just something we got to be honest with there, okay? All right, guys, appreciate you joining me. Thanks so much for being here, as always. If you're looking to apply, join my private group, learn from me on a deeper level, get access to all my course curriculums, 6- and 7-figure Discord chats, access to see the moves I'm making, which I made a bunch of moves in my public account here today, $2 million plus Fidelity account, then click on the pinned comment of this video, fill out an application, and we'll see if we can get you in there next week. Have a great long weekend, much love, and have a great day.